Why is it that some companies seem almost invincible, weathering recessions, technological change, and waves of competition, while others, once celebrated, vanish into history? Every generation of investors faces this puzzle. The market dazzles us with innovation, headlines, and new opportunities. But as the years unfold, we see a pattern emerge. Most companies rise quickly and fall even faster. Only a few endure. And so the timeless question stands: what makes a company truly durable? What separates a fleeting success from an enduring enterprise? Benjamin Graham wrestled with this very question nearly a century ago. In an era defined by speculation and collapse, he was one of the first to ask not merely what a company could earn this year, but what allowed it to keep earning through every kind of year. To Graham, investing was not about predicting the future. It was about recognizing permanence amid change. He sought not excitement, but endurance. Not the fashionable, but the reliable. And in doing so, he uncovered something that modern investors too often overlook. A company's true strength is rarely found in its growth rate or market share. It lies in its character. As Graham wrote, the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. He understood that when optimism runs high, almost every business looks promising. But when the tide recedes, as it always does, only the companies with genuine durable advantages remain standing. So in this episode, we explore what Graham called the essence of sound investment, the search for economic durability, the ability of a company to survive, adapt, and thrive, not for quarters or years, but for decades. We'll uncover how Graham defined these enduring traits long before terms like economic moat entered the investing vocabulary, and how even today, his quiet logic can help us see through the noise of modern markets to identify the rare few businesses built to last. Because in the end, markets will always fluctuate, but enduring value never goes out of style. Benjamin Graham began his career in the early 1900s, a time of both extraordinary growth and devastating collapse. He witnessed railroads rise and fade, industrial giants expand beyond reason, and fortunes evaporate overnight. From these experiences, he learned something most investors still struggle to accept. Growth in itself is never proof of durability. During the roaring 1920s, investors poured money into any company that showed a hint of expansion. New industries, automobiles, radios, chemicals, were reshaping the world. It felt like a new economic era. And yet, when the crash of 1929 came, it exposed a truth that Graham would never forget. Many of those innovations had no staying power. Their profits were temporary. Their appeal was emotional. Their structures fragile. When the panic cleared, Graham turned his mind not to the wreckage, but to the question, what made some companies survive when others disappeared? He found that the survivors shared something subtle, a foundation of conservatism, both in management and in structure. They didn't rely on constant external financing. They avoided overexpansion, and most importantly, they built economic resilience into their very design. These weren't always the most glamorous firms. In fact, many were dull. Manufacturers, utilities, or insurers, the kind of businesses that rarely made headlines. But while others rode the waves of speculation, these companies built seawalls. Graham began to formalize this insight through his analysis. He didn't call it a moat. That term would come decades later. But he understood the concept perfectly. He wrote, "The chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions." He understood that when optimism runs high, almost every business looks promising. But when the tide recedes, as it always does, only the companies with genuine durable advantages remain standing. So in this episode, we explore what Graham called the essence of sound investment, the search for economic durability.
In that single line lies his entire philosophy of endurance. A truly great business, Graham taught, is one that can withstand adversity without losing its earning power. He wasn't searching for brilliance, he was searching for consistency. Because brilliance fades, but consistency, built on discipline and strength, endures. And so, Graham developed a mental checklist, a kind of quiet radar for identifying such companies. He looked for long-term profitability, strong balance sheets, conservative financing, and honest management. He preferred companies with simple, understandable products, where demand was steady and replaceable. He valued businesses whose customers returned not out of excitement, but out of necessity. It was this shift from speculation to permanence that set Graham apart. While others searched for the next big thing, Graham searched for the next lasting thing. And that distinction made all the difference. Because to Graham, the goal of investing was not to be right this year, but to remain right for decades. To Graham, durability wasn't about dominance, it was about defensibility. He wasn't impressed by size, headlines, or even temporary profitability. He was impressed by repeatability, the quiet ability of a company to earn money predictably year after year through good times and bad. So, what exactly makes a company's advantage durable? Graham would say it begins with character and it ends with structure. A company's true strength lies not in what it promises investors, but in how it conducts itself when no one is watching. This character is revealed in the way it handles debt, treats its shareholders, manages its inventory, and reacts to economic cycles. Durability, therefore, is not a single factor, it's a system of habits. Let's break it down the way Graham would have. 1. Conservative financing. Graham believed that a company that cannot survive adversity does not deserve your trust. He once remarked that the chief losses to investors come from the purchase of low-quality securities at times of favorable business conditions. In other words, everyone looks brilliant in a boom. But real strength is proven only when credit tightens, margins shrink, and the tide goes out. A durable company carries little debt relative to its assets. It can weather storms without pleading for capital. It safeguards liquidity as a form of independence. 2. Stable and recurrent earnings. Graham emphasized long-term earning power over short-term profit spikes. He looked at 10-year averages, not quarterly surprises. He reasoned that the best measure of a company's future is the consistency of its past. As he wrote, investment is most intelligent when it is most businesslike. And in business, you do not pay for dreams, you pay for cash flows that actually arrive. Durable companies demonstrate the discipline to earn steadily in all kinds of weather. 3. A business model rooted in necessity. This is one of Graham's most underappreciated ideas. He favored businesses that provided something people would keep buying, no matter the economy. Not luxuries, not trends, but essentials. It could be a manufacturer of industrial components, an insurer, a food company, or a utility. These firms don't always excite the market, but their demand is built on need, not novelty, and need endures. 4. Strong managerial integrity. To Graham, numbers meant little without trust. He repeatedly warned against managements that were promotional, optimistic to excess, or careless with shareholder capital. Durability requires honesty, the kind of leadership that views profits not as rewards to flaunt, but as resources to protect. He wrote, The investor's chief problem, and even his worst enemy, is likely to be himself. But the same can be said of managements. Companies fail when they begin believing their own stories more than their balance sheets.
A durable competitive advantage, in Graham's terms, was therefore a compound of restraint, prudence, and real economics. It was not about what the company sold, but how it operated. In his view, markets were obsessed with speed and innovation, but investing, at its highest form, was about stability and endurance. The market rewarded brilliance briefly, but it rewarded discipline eternally. So when we ask, what gives a company a lasting edge? Graham would answer simply, the ability to stay solvent, honest, and profitable through the full cycle of human optimism and fear. And that definition, though simple, may be the most profound defense any investor can build. Benjamin Graham never relied on slogans or hunches. He tested ideas with data, and he tested durability with discipline. To him, a company's true advantage wasn't what it claimed in its annual report, but what it proved over time. And time, Graham believed, was the most ruthless auditor of all. He developed a method, practical, almost surgical, to separate solid enterprises from fragile illusions. Let's walk through how Graham examined a company's durability step by step. 1. The 10-year test. Graham began not with forecasts, but with history. He would say, the future is uncertain, but the past, if interpreted correctly, contains valuable lessons. So he looked for companies that had demonstrated at least 10 years of consistent profitability. Why 10 years? Because that period captured multiple business cycles, booms, recessions, and recoveries. Any firm that could remain profitable through all that had, in his words, passed the test of time. This filtered out the one-season wonders, those that thrived on temporary conditions or fashionable demand. A company that had earned steadily was more trustworthy than one that had promised greatly. 2. The balance sheet test. Next, Graham turned to the balance sheet, the financial anatomy of a business. He examined liquidity, leverage, and asset quality with a surgeon's precision. A few of his guiding principles were timeless. Current assets should at least double current liabilities. Long-term debt should be modest compared to equity. Tangible assets should provide real backing for the stock price. These weren't rigid rules, they were filters for soundness. Because Graham knew, a business that needs perfect conditions to survive is not an investment. It's a speculation dressed in numbers. His philosophy was defensive at its core. He wanted companies that could stand unaided, even in stormy weather. And to him, solvency was the truest sign of strength. 3. The dividend record. Another test Graham used was the dividend record, a symbol of discipline and reliability. He wasn't obsessed with high yields, but with consistent payments to shareholders. He wrote, "One of the most persuasive tests of high-grade common stocks is an uninterrupted record of dividend payments going back over many years. A company that paid and kept paying even when times were hard revealed not just earnings, but integrity. It showed that management respected shareholders and managed cash with restraint. Dividends, to Graham, were the bridge between reported profits and real profits. Anyone can print an income statement, but only a truly durable business can part with real cash year after year." 4. The earnings stability test. Graham didn't just look at how much a company earned, but how reliably it earned. He smoothed profits over a decade to calculate average earning power. This avoided being misled by boom year surges or temporary losses. If earnings were erratic, if the line swung wildly from profits to losses, Graham stepped back. Volatility in earnings meant volatility in value, and volatility in value meant fragility. To him, a durable business was one that did not need luck to be profitable. 5.
the valuation margin. Finally, after confirming durability, Graham returned to his central doctrine, the margin of safety. Even the most enduring company could be a poor investment if purchased at the wrong price. Durability was necessary, but not sufficient. He reminded investors that no advantage is worth overpaying for. The greater the uncertainty, the larger the margin required. This margin was not an act of pessimism, but of respect. Respect for the market's unpredictability and for human error. In this way, Graham's process for testing durability was both scientific and philosophical. He didn't seek perfection, only resilience. He wasn't hunting for the next Amazon of his time. He was building a portfolio that could survive history itself. His approach stood in quiet defiance to Wall Street's obsession with excitement. While others chased innovation, Graham built armor. And it was that armor, those durable, unexciting, financially sound companies that allowed his students, including Warren Buffett, to sleep peacefully through storms that wiped out fortunes. Durability, in Graham's view, wasn't a trait to be admired. It was a requirement to be demanded. Nearly a century has passed since Benjamin Graham first wrote Security Analysis. Markets have evolved, industries have transformed, information moves at the speed of light, and algorithms trade in microseconds. And yet the fundamental challenge facing investors remains exactly the same. How do you tell the difference between what's temporary and what will last? In Graham's day, the mania surrounded radio and railroads. Today, it's artificial intelligence, electric vehicles, and biotech breakthroughs. Each generation believes its moment is unique, that the rules of prudence have somehow changed. But history keeps whispering the same truth. Fashion fades, fundamentals endure. So what would Graham look for if he were investing today? What would his radar of durability detect in the modern market? Let's bring his timeless logic into the present. 1. Look for repeatable, not just scalable, businesses. Modern investors often chase scalability, the ability for a company to grow quickly. But Graham would remind us that repeatability matters more than speed. He'd prefer a business that earns modestly but steadily over one that earns spectacularly but sporadically. Think of companies like insurance firms, consumer staples, or payment processors, businesses that serve essential needs and generate predictable cash flow. Durable companies in the modern world are not necessarily the fastest to grow, they're the hardest to disrupt. 2. Favor financial strength over market story. Today, many investors buy stocks because of a story, the narrative of potential. But Graham would look straight through the narrative to the numbers beneath. He'd ask, does this company have enough liquidity to survive a downturn? Can it operate without raising new capital every few years? Are its earnings built on genuine demand or on cheap credit and hype? Financial strength, the old-fashioned kind, remains the cornerstone of durability, even in an era of innovation. Because no matter how new the business model, it must still obey the oldest law of economics. Cash in must exceed cash out. 3. Study management behavior during adversity. One of Graham's most profound lessons wasn't about accounting, but about human behavior. He understood that true character is only revealed under pressure. So in today's market, an investor searching for durable companies must look at management's record during difficult times, recessions, industry slowdowns, or market panics. Did they protect the balance sheet? Did they prioritize long-term stability over short-term appearances? Or did they reach for risky acquisitions and debt-fueled expansions? Durability is forged in crisis, not comfort. And the managers who act wisely when everyone else is fearful often create companies that last for generations.
4. Focus on economic moats you can actually measure. Modern investors love the word moat,
But Graham would caution that many so-called moats are illusions, marketing gloss painted over fragile economics. To him, a moat had to be quantifiable. You could measure it through margins, return on equity, customer retention, and competitive costs. If these metrics eroded over time, the moat was drying up. In today's terms, Graham's eye would gravitate toward companies whose products or services are so embedded in daily life that replacing them feels unnatural. Not the flashiest firms, but the indispensable ones. Think of the companies quietly powering transactions, logistics, infrastructure, or essential technology. Not those selling the trend, but those selling the tools that trends rely upon. 5. Beware the illusion of permanence. The irony of durability is that it's always under threat. Graham knew that every advantage invites imitation. He would urge modern investors to never assume that today's winner is immune to tomorrow's disruption. Even the strongest moat must be maintained through innovation, prudence, and humility. When management grows complacent or investors grow overconfident, the moat begins to drain. So Graham would tell us, respect success, but never worship it. Because the investor who worships permanence is always the first to be surprised by change. 6. The Grahamian eye for simplicity. In an age obsessed with complexity, derivatives, forecasts, and data overload, Graham's simplicity feels almost revolutionary. He would still begin his analysis with 3 questions. 1. Is this business understandable? 2. Can it earn consistent profits through cycles? And 3. Am I paying a price that leaves room for error? If the answer to any of these was no, he moved on, no matter how exciting the story. And that, perhaps, is the essence of durability, clarity in an age of noise. When applied to the modern market, Graham's principles act like a compass, cutting through hype, reminding us that the goal is not to find the next miracle, but the next reliable earner. Because the investor who survives is not the one who predicts best, but the one who endures longest. Benjamin Graham was, above all, a philosopher of finance. He understood that the search for durable companies was in truth a reflection of a deeper search, the quest for durability within ourselves as investors. Because behind every investment decision lies a battle, not between investor and market, but between reason and emotion. Graham taught that a durable competitive advantage in business means nothing if the investor lacks a durable temperament. He wrote, "The investor's chief problem and even his worst enemy is likely to be himself." It's one of his most quoted lines, but few truly grasp its depth. He didn't mean that investors are foolish. He meant that investors are human, drawn by hope, fear, greed, and impatience. These forces, invisible yet powerful, corrode even the soundest logic. And just as a company must defend its profits against competition, an investor must defend his judgment against emotion. Durability in business begins with resilience. Durability in investing begins with restraint. The investor's moat. Graham believed that investors, like businesses, must build their own moat, not of patents or pricing power, but of principles. Your moat is your discipline. Your margin of safety is your humility, and your true competitive advantage is the ability to act rationally when others cannot. He might say, a company earns its advantage by doing in business what others find difficult. The intelligent investor earns his advantage by doing in markets what others find impossible, staying calm. This mindset transforms the act of investing from speculation into philosophy. It turns the market from a battlefield into a teacher.
Time as the final judge. Graham's view of time was quietly radical. He believed that time was both the market's equalizer and its ultimate filter. It rewards discipline, and punishes arrogance. He once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Those words are as true today as they were in 1949. Durable companies and durable investors both understand this. They do not seek applause, they seek endurance. They are content to let others speculate while they accumulate strength, quietly, patiently, persistently. Humility as strength. At the heart of Graham's philosophy is humility, not as weakness, but as wisdom. He understood that no analysis is perfect, no forecast certain, no advantage eternal. Humility keeps the investor realistic, patient, and alert to change. A durable investor asks, not how can I win more, but how can I avoid losing permanently? Because avoiding ruin, both financial and emotional, is the real path to compounding success. The enduring spirit. Durability, then, is more than a business trait. It's a way of thinking. It's the quiet conviction that substance matters more than style, that patience outweighs prediction, and that integrity compounds faster than opportunity. To seek durable companies is to align with the rhythm of reality, not to outsmart it, but to understand it. It's to say, I will value what lasts, even if the crowd values what shines. That, in essence, was Graham's genius. He didn't just teach investors how to pick stocks, he taught them how to think and how to endure. Because in the end, the most powerful advantage in markets is not found in numbers, it's found in character. If Benjamin Graham were alive today, watching the chaos of modern markets, the streaming tickers, the algorithmic trades, and the endless noise, he would likely smile softly, as he often did, and remind us, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. That is where enduring success begins, not with forecasts, not with following trends, but with reasoned conviction grounded in evidence. How to apply this lesson today? Let's bring this timeless philosophy into the world you and I invest in now. To spot companies with a durable competitive advantage, ask yourself 3 quiet, rational questions. 1. Does the company control its destiny? Look beyond products and profits. Does it command its supply chain, its brand, or its customer relationships in a way competitors cannot easily replicate? True durability means independence from constant external threat. 2. Can it survive the storms? Durability isn't measured in growth, it's measured in resilience. How did the company act in 2008, in 2020, or during industry crises? The record of how it endures hard times tells you more than 1,000 optimistic forecasts. 3. Is management a steward or a speculator? Graham admired managers who viewed shareholders as partners, not opportunities. Study how they allocate capital. Do they reinvest wisely, maintain a margin of safety, and act conservatively when others overreach? If the answers are yes to these, you're likely looking at a business that endures. But more importantly, if you learn to ask these questions consistently, you become the kind of investor who endures. The modern edge. Patience in an impatient age. In a world obsessed with speed, Graham's principles are radical acts of patience. Every day the market tempts you to trade, to react, to move, but Graham invites you to wait. Because while trends fade and enthusiasm burns out, value reveals itself slowly. To follow Graham today is to choose clarity over excitement, discipline over drama, time over timing.
It's not about predicting what the market will do next week. It's about preparing for what the world will prove right in the next decade. That's how you build a life and a portfolio on something durable. The closing reflection. The quiet power of rationality. Benjamin Graham never promised riches. He promised something far rarer, rationality, in a world that had forgotten how to think. His students, from Warren Buffett to countless unknown investors, found in his teachings not a secret formula, but a way to see clearly when others are blinded by emotion. To understand durability is to understand that success in markets is not about brilliance. It's about behavior. It's about doing the simple things, research, patience, discipline, when others refuse to. And when you do that, time becomes your ally, not your enemy. Nearly a century after The Intelligent Investor was published, the market still rewards those who live by its spirit. The names of the great companies may change, but the principles that define them do not. Durable businesses are built on integrity, prudence, and foresight. Durable investors are built on the same. Graham's wisdom reminds us, the essence of investment management is the management of risks, not the management of returns. And that's what a durable advantage, both in business and in life, is really about. Not chasing more, but losing less. Not reacting to noise, but listening to reason. Not winning quickly, but lasting quietly. Because in the end, what truly compounds is not excitement, but endurance. So if you found value in this reflection, if you believe in reason over speculation and wisdom over noise, then join us. Subscribe to Benjamin Graham Value Insights, and together we'll continue to preserve and share the timeless principles of the father of value investing. Because while the market changes every day, wisdom does not.